Welcome to the Man from Macro, where we look at some of the big themes in today's global markets. Currently, there's an expectation that the Fed will cut interest rates in 2024 because inflation will fall towards their 2% target. But as ever, that's only one of the factors to take into consideration. In fact, it might be the least important, but it's the one that the market is getting very excited about. However, what if inflation dropped to the Fed's 2% target, but the equity market stormed to new highs, whilst unemployment remains either near or below 4%? Would the Fed want to cut rates if the economy and markets are performing well? The answer is probably no. That's because US corporates have tended to hoard jobs or renew hiring if the equity market is performing well. If they hoard jobs, that increases the risk of sticky wage inflation. And it's wage inflation, rather than spikes in commodity prices, that tends to lead to inflation becoming embedded in an economy. You see, the outlook for inflation is all about animal spirits, and if those are improving, then it increases the risk that the Fed will need to maintain a hawkish stance. Remember, inflation is generally backward-looking. We have historically seen multiple consecutive inflationary spikes. The recent spike may be a one-off due to the exogenous impact of COVID and the fiscal policy response. But the Fed might not want to throw off the shackles too early. And this creates a dilemma. If we are heading towards a recession, then the Fed should cut rates. But the equity market and unemployment rate are acting as if a recession is still distant. And because the market thinks that the Fed is going to pivot because of softer data, financial conditions have significantly improved due to the rally in equities, the fall in bond yields, and the tightening of credit spreads. This improvement in financial conditions should boost economic activity. Therefore, if the market pivots, in anticipation of the Fed pivoting, it means that the Fed might not need to. In fact, they may need to maintain a hawkish stance in which rates plateau as they did in the 1990s. This could keep the cuts off the table in 2024. Therefore, the market should be careful what it wishes for. The Fed would prefer to cut rates into a clear and present recession, rather than overcompensate by cutting too early and running the risk of inflation returning. And every recession since 1950 has seen a tradable low in the S&P 500, even when they have been shallow events like 1980 and 1991. Of course, we could be in a scenario in which rates are cut whilst the equity market is still rallying before the recession has begun. But that would be unusual. Rates have generally been cut after the equity market is already in trouble. We should realistically only expect a rate cut after a decline in the equity market has confirmed an economic slowdown. So, in 2024, if the equity market continues to rally, rates should be on hold at the very least, with risks of further hikes, even if inflation does fall back to target. And please remember, none of this is investment advice. These are just observations for educational purposes only, and everyone should be aware of their own investment objectives and risk profiles. But thanks for watching.